The two headlines currency traders care most about come from Berlin and London. The BoE boosted its asset purchase programme by £75 billion, while Jean-Claude Trichet opted against a rate hike in his last meeting as president of the European Central Bank. Stephen Gallo from Schneider FX has been following events and joins me down the line. Stephen, do you interpret the BoE's decision as a sign that the UK economy is in real trouble?
Well, I think, the UK economy is in real trouble, and I think the UK economy has been in real trouble ever since the crisis struck in 2008, 2009. You could even argue that the UK was in real trouble as early as 2004, 2005, 2006, because that was when the bubble, which burst in 2007, 2008, was accumulating, was growing. So I think the UK economy has been in serious trouble for a very long time. I think that, the fact that we had a bubble of that magnitude in the UK means that the model of economy that the UK economy is running, which I think I've discussed with you before, is impaired, seriously impaired. But overall, I think it's not really a surprise that the Bank of England moved on quantitative easing. It was just a surprise as to the timing. But if you're minded like the Bank of England is minded, if you're minded like the members of the Monetary Policy Committee is minded, then waiting longer doesn't really make sense in this environment when you have bank conditions deteriorating, when the outlook for growth in 2012 has deteriorated. There really doesn't make much sense to hold things off. So I think that's why they moved. The only other comment I would make about the Bank of England is that it's clear from the statement that they made that a significant portion of the decision was related to what is going on in the euro area, which of course is the UK's largest trading partner.
And if we turn our attention to the ECB, from reading your morning notes, you seem to be more sympathetic towards keeping interest rates where they are for a while.
Well, I don't know about wait a while. I just say keep rates where they are and try to attack the problems that are affecting, the banking system and the financial system with other creative means, which the ECB has been doing, much to their credit and their credibility. They've been doing that since really August of 2007. They've been using their non-standard measures. They expanded and enhanced some of those non-standard measures today. On the subject of interest rates, my view is that keeping interest rates on hold, the 50 basis point hike in rates, which was delivered earlier in the year, has more value as a medium-term anchor of stability and inflation control than a minuscule 50 basis point cut today would have for the real economy in the near term. I also point out to you that this is not a crisis of cost of funding. Yes, the cost of funding has gone up and increased sharply for many banks in the euro area, but that's because this is a crisis of confidence. It's not a crisis of cost. Lower interest rates is not going to save the economy. It's not going to save the banking system. What we need is confidence in the banking system, and therefore we need to see very aggressive measures from policymakers in the euro area, recapitalize the banks, move towards closer fiscal integration, move towards closer economic integration in the euro area. That will restore confidence to the banking system, not a minuscule 50 basis points or even, I would argue, 100 basis point rate cut.
Stephen Gallo there with some more quality analysis. On Friday, I'll be speaking to the European Banking Federation about interbank liquidity issues, a topic which Jean-Claude Trichet mentioned repeatedly in his press conference. Goodbye for now.